Hey, this is Josh. Today is Tuesday, August 1st. Today was a large trading range day. Pretty interesting. Went from a sell the close bull trend to a buy the close bull trend, back to a sell the close bear trend. I came in somewhere around here. Prices were in this small trading range. Overnight, prices had formed a second leg down and a double bottom with the start of yesterday's bull channel, and likely to evolve into a large trading range. The bears were attempting to form a bear channel, but it was weak. The trend channel line is easier to see. There was not really a great fit on the trend line side. I prefer to play it as a trading range rather than a channel in these types of cases, unless the channel is clear. I came in somewhere around in here. This was a weak low one sell setup at the bottom of a trading range, so reasonable to buy below here as an acceptable scalp. There was not really a good entry as far as entering with a stop. An aggressive trader may consider selling these closes, but in my opinion, it's not. That's pretty aggressive, and you have to be pretty good at reading price action and also willing to scale in. So in my opinion, they're not best entries. This was a low 2 sell setup at the top of the trading range. Arguably reasonable to sell below here on a stop, but you're selling in the middle of a limit order market on a stop, and prices are in like a 10 pip trading range. In order to reach a scalper's profit on this, prices would have had to have broken out down to here, and as you can see, they did not. This was a high 2 buy setup. Again, stop entry in the middle of the trading range. So if you're going to enter this, you need to take it for a swing or plan on scaling in lower. The bulls attempted at a high 2 here. The bears tried for a failed high 2 and an outside bear bar. Bulls tried for a second attempt here, did not trigger. Instead, prices went out the bottom, making this a repeat pattern to here. Very similar. If you look at the price action, bull bar, bear bar, bull bar, bull bar, bear bar, bull bar, weak low one, bottom of the trading range. Again, acceptable scalp to buy below here, looking for a scalp up. The bears tried for a small micro wedge top, 3 pushes up, and a bear flag, but this was a reasonable swing short for that setup. Bears got good entry, decent follow through, but this is still a stop order entry in the middle of a tight trading range. So again, if you're going to take this sell, you need to take it for a swing. And also, the buying pressure has been relatively strong. You're near support. Like I said, this is support from yesterday, and the bulls have been aggressive so far. Big bull bar, bull follow through. Took several bars to reverse these 2 closes. Outside bull bar, again strong bull bar, and then another strong bull bar here, which reversed all of these prior bear closes. So strong buying pressure, and you're selling near the low of a larger trading range. So I think this is a pretty risky sell setup. However, buying above was also risky because you're buying into the high of a trading range and you're buying above a bear bar. It's only a high 1 buy setup. So if you take this, you have to take it for a swing trade. A scalper will likely wait for the breakout and then enter either on this close, or below this bar. I think the best entry was buying below this bull breakout bar. It was a weak low 1. Prices had clearly flipped to always in long with the bull breakout, making this a weak low 1 sell setup and a breakout pullback buy setup. So acceptable scalp to buy below here for a test up, and prices made a measured move up based on the height of this small trading range. And this was also the high of this larger trading range was also resistance overnight. You can see it was the top of this smaller trading range from the overnight price action. This was a failed bull breakout of yesterday's or of the overnight trading range. This sell setup is an okay swing short, but it's not great. It's only a first entry, pretty strong buying pressure. I think the bears are going to need more to reverse the market. However, you can see that these by the close bulls were trapped and they were exiting. They had scaled in and they were exiting. It was pretty obvious. Look at the tails. There's 1, 2, 3, 4 attempts to break above the close. Only one bar could reach above the close, and that was this bull bar, making this a weak high one at the top of the trading range. However, the trading range was not clearly evident at that point, so reasonable to sell above this bar with a limit order. Probably high enough probability for an acceptable scalp, but since the trading range was not clearly evident, at least on today's price action, I think that you need to be willing to scale in if you take that entry, and therefore I did not mark it as a best entry. However, price has formed this 2-bar reversal and a low 2 sell setup. These bulls are trapped, failed high 1, low 2. So reasonable swing short, looking for a test back down, at least to the top of the prior trading range, possibly down to here. And as you can see, turned into a huge sell to close bear trend. Bears got good entry, good follow through. The market became always in short here. Good sell to close bar. It's also a low 1 sell setup, but if you're selling below and using a stop up here, I think you need to take it for a swing trade. But if you sell the close with a stop up here, probably high enough probability for a scalp. And this is an interesting setup because you can take this for an always in position, you can take it for a scalp, or you can take it for a swing trade. So this is this does not happen often. This is pretty rare, but it's pretty interesting how you can manage trades differently based on the style of trader you are, even though you're taking the same entry. But reasonable sell the close bar for either all 3 types of traders. As I said, always in trader, stop up here. Swing trader, scalp, probably stop above the signal bar, looking for 2 times his risk. And then a scalper would probably use a wide stop up here, maybe higher, and be willing to scale in. However, did not need to, quickly sold off in a strong bear bar and bear breakout of the earlier trading range. Prices ended up going for a measured move down based on the height of the opening range. It was possible that prices made a measured move based on the entire trading range from the overnight price action. We came close but did not quite reach it. This you can argue selling this close as well because it's a breakout of the earlier trading range. But this bar, this was technically the follow through bar, and this bar ended the sell to close bear trend with this large tail. So for those reasons, I do not think these are best entries. However, an aggressive trader will probably consider entering at those closes. I'm personally not that aggressive. This was after this strong bear leg, prices were likely to make a second leg down, possibly form a bear channel. The bears formed a small tight bear channel here, making this a low 1 sell setup and failed bull reversal. Okay, swing short, probably not high enough probability for a scalp. It's a breakout pullback short to the bottom of the earlier trading range. The bulls tried for a second entry here in a double bottom, but the signal bar largely overlaps the prior 2 bars. You're buying in the high of a potential bear flag, so risky to buy above there unless you're taking it for a swing trade. Even if you're a swing trader, I think that's a low probability swing buy. I would say around 40%. I prefer to look for 50-50 for swing entries. I prefer to look for 50% entries, which are what these squares are. The minimum I will mark is a 50% swing entry. All other swing entries are 40%, and I do not mark those. So the bears formed a failed high 2, but at this point you're selling low, so probably better to wait, but on a strong trend day, not unreasonable. However, today is mostly sideways and you're selling near the low of the day. The bears, there was some signs of buying pressure, like the fact that the bears could not reach that measured move target down here, and prices reversed. Remember what I talked about sell Climax Remember I talked about this being the second buy climax yesterday, and price is likely to test below. And look what happened. Prices tested right below the bottom of that climax and reversed up strongly. So this was a potential support area, which in fact it did hold as support up until this point. So selling below this bar, selling above could be considered an acceptable scalp, but you need to be willing to scale in, and for that reason I'm not marking it as the best entry. Selling below, too risky because you're selling into the low of the day. This was a nested, the bulls tried for a failed failure and a second entry here. Weak signal bar, doji. Again, poor swing buy. However, this was a nested wedge bottom. You had one push down, two pushes down, and then this outside bear bar, prices went up above this bar and back down, making it a third push down. Or you can consider it a two-leg test of this low after a break of this micro bear channel. Either way, reasonable swing short. This was a small sell climax and final flag reversal. Not all of a great of a setup because it's a doji bar. However, this bar was a stronger signal bar, so reasonable. It's also a small double bottom with this bar here, so reasonable to take this for a swing up, possibly to here, or at least at the time it looked like prices were forming a bear channel, and so it's reasonable to look for a swing up. This the market, I wouldn't say it's clearly always in long here. It was likely to make a second leg up, making this a weak low one buy setup. But there was not all that much room to the EMA, not quite enough room for a scalper's profit. Therefore, I think that it's somewhat risky and not necessarily a best entry. However, not an unreasonable trade to buy below there if you're willing to scale in. Prices at this point, you can consider it always in long here from the bull entry, bull follow through from this setup. But I wouldn't say it's clearly always in long until over here when we have a bull breakout above the small bear flag and above the EMA and a breakout back into the earlier trading range. But reasonable you can argue that the market became always in long here. The bears tried for a low 2 sell setup here at the EMA and start of a bear channel. Could not trigger. Instead, the next bar became an inside bar and a bull bar, decreasing the probability of the sell setup. Still an okay swing short if you expect a channel, but mostly sideways day, trading range, selling into the low, so not a great sell setup below there. The bull instead, the bulls formed a failed low 2 and double bottom bull flag with this bar here. And start of the second leg up. So reasonable swing buy above here. The bears tried to turn it into a failure. The bulls got a good entry bar. The follow through bar was not great, and the bears tried for a variant of a failed high 2, first entry, second entry, but and prices ticked below the entry bar. However, instead of selling off, the market, the next bar became a bull bar, and you can consider it a second entry for here. So the bulls were able to take control and rally the market. This turned into a buy the close bull trend. The bulls got a strong breakout above the high of this, above the earlier lower high, making this a reasonable buy the close bar. It's a bull follow through from a bull breakout of a bear flag. A while back I was talking about bull breakouts of a bear flag, and this is a good example. It's a low probability event, but when it happens, you can't ignore it. So I thought that this close and this close around the same price level, I thought it was a likely target, and that was where the bulls were likely trying to reach. So, and as you can see, prices reached the closes and then sold off. This was also a weak low 1 buy setup, weak reversal setup, so acceptable scalp to buy below. with a limit order. You are buying near the high of the trading range, but like I said, these closes were targets. Buying above here was a high one buy setup, but buying on a stop this high, I think it's risky unless you're taking it for a swing trade. You could consider arguing it as a high enough probability for a scalp because there is enough room to these closes, hardly. But personally, I think it's better to buy below this bar with a limit order than to buy above this bar and a stop. So this turned into a failed bull breakout of the larger trading range and a sell setup, but huge bar, huge doji, really strong buying pressure. First bear bar. It is a second entry short, but it's the first bear bar in the prior 10 bars or so. In a large risk, so I don't think that this is necessarily a great short to take. However, prices did flip to always in short on the bear follow through bar here. This you could consider as a weak high one buy setup after a reversal, but again, prices could have easily, this was technically a failed low too, so prices could have rallied higher and tested near up here more, but instead, prices sold off into another sell the close bear trend. Selling above this bar was not a necessarily bad trade. It was a weak high two. Weak high two buy setup. It's above a bear bar, but this is late in the day. It's after my cutoff time, so for that reason, I did not mark it as a best entry. But you could argue that it is a reasonable entry for an acceptable scalp. I have quite a few questions to go through, but I don't think I'm going to make it through all of them again today. I'll try tomorrow, but I'll try to go through a couple real quick. One thing I wanted to bring up is yesterday I had the question about putting your stop at break even, and there was a point that I wanted to make but I forgot, and that is to always remember the trader's equation. Anytime you decrease your risk, you decrease your probability of making a profit. So you always have to remember the trade-off between the variables in the trader equation. So I just wanted to bring that up real quick. So basically, tightening your stop is going to decrease your probability of making a profit. So with that, I'll start with the next questions. Okay, first question. In the Forex markets, how can you take advantage of what price is more likely to do on the actual day? Brooks explains what occurs with the opening of the E-mini market. If it opens with reversals, overlapping bars, or trading range price action, it is likely to be a trading range day. But in the Forex markets, there are different openings, Europe, Asia, and USA. Yeah, that is a very good question. I only trade the U.S. Open and the U.S. time. So I tend to somewhat ignore the overnight price action. But before I was using this platform, I was using NinjaTrader, and I had my data set up to start at 7 a.m. And that was because, so basically around here, and that's because prices tend to, the volume tends to pick up around 7, and that way I could see the price action compared to yesterday, and it made it a lot easier to differentiate the type of day like he's saying. When you have, unfortunately with this platform, I can't do that, so I have to look at the overnight price action, and so it kind of makes it harder to tell what is happening based on yesterday. But the the theory still remains the same. So like today, I consider the open as being whenever I come in. 7, you can consider it 7 or 8, doesn't really matter. 8 is probably a better choice. But look at what's going on at the open. Prices are sideways. So that tells me today is likely to become a trading range day. Both the bulls and the bears are making scalpers profits, so both are aggressive. And look at what happened. Prices turned into a large trading range day. Yesterday was a bull trend from the open. I'd have to go back, but so the theory is the same. So basically, If prices are reversing a lot on the open, then it's likely to become a trading range day. If prices are clearly in a strong trend, it's likely to become a trend day. You can also compare the today's open with yesterday's close, which I consider, I know I can understand it's confusing because Forex markets don't close, but I still consider the close as being around 5 o'clock, so somewhere around, I think around in here. And if you did not have this overnight data in here, you would see a bear gap down into a sideways trading range, and that means a failed bear trend from the open. So, and I don't necessarily think that it matters which session you trade. This can be applied to any session, any market, any time frame. So, so basically, pay attention to the open, and you can try to decipher as the day goes on. I'd say within the first 2 hours, you can pretty much tell what kind of day it's going to be. At least you can, I would say most of the time you can tell, except for like Friday was a pretty unusual day where it wasn't necessarily clear. But most days are pretty clear by, I'd say, 10 o'clock or so. He has a question about Friday, but I don't have time to get into Friday. So next question, how do you find it's a better way to trade? Option 1, focusing on the bars you have at your left, maximum last 60 bars, or option 2, focusing on higher levels of support and resistance, prior highs and lows, trend lines, trend channels from the past. He says, Brooks seems to like to analyze bar by bar, and it seems that he doesn't pay attention to what happened 2 or 3 days ago if there wasn't something important, and sometimes trying to combine both can take to confusion. Yeah, I agree. I think that if you're trading higher time frames, then you need to focus on higher levels of support and resistance. But if you're trading a 5-minute chart, I think you're going to confuse yourself if you're trying to look for higher levels of support and resistance. So personally, I only pay attention to I trade as Al Brooks does, bar by bar, and that's because what's going on right now is different than what was going on even 20 bars ago. So this, for example, both sides are initiating trades, both sides are scalping, both sides are scaling in, and then look what happens. All of a sudden, there's a strong bull breakout. So what was happening 5 minutes ago or 5 bars ago doesn't necessarily apply. So I'm not saying that these price levels won't come into effect later on, but I'm mainly interested on what's happening right now. What are the institutions doing right this minute, this bar, the past 2 or 3 bars? Because like I said, it can change over the course of 2 bars. So it went from a trading range to a strong bull trend and to a strong bear trend. So if you're focusing on what they were doing, so if you're thinking, okay, prices are in a trading range, I'm going to buy low, sell high, and scalp, and then this happens, what are you going to do? Because you're not prepared for that. You were expecting the trading range to continue, but now the trading range has not continued, and prices are breaking out strongly. So I think it's more important to pay attention to what they're doing right now than higher levels of support and resistance. But I would say the past 20 bars or so is what I pay attention the most to. However, I do pay attention to previous levels of support and resistance, especially on a day like today where it's a trading range day. So mainly focus on the bar-by-bar price action. Next question. Normally, a trend reverses when there has been damage to the trend line because of a certain level of support and resistance. How can you define enough selling or buying pressure for reversing a trend? It must be very subjective. Yeah, trading itself is very subjective. Basically, if a strong trend line is broken, you expect a retest of the high or the low. If the retest of the extreme has many overlapping bars, then a reversal is more likely. The retest may be 2 or 3 legs. If, however, the retest is there are very few overlapping bars. Like there was an example one day last week whenever I talked about how the selling pressure or the buying pressure on the retest was weak and one side was clearly stronger. So if the retest of the trend extreme does not contain overlapping bars, then it's better to not look for a reversal because it's a lower probability event. So as far as how do you define enough selling or buying pressure for a reversal, I think that depends on the type of trend. If there's a climax, then the reversal can be more likely. If instead it's a small pullback trend, then there may be a big two-leg correction, and then prices continue with the trend as if the two-leg correction never happened. So I think that it depends on the trend. It depends on the day. So yes, it is very subjective. But basically, if there's building selling pressure in a bull trend or building buying pressure in a bear trend, prices will likely transition to a trading range. And then from there, prices can evolve into a reversal or a trend in the opposite direction. Okay, next question. How long did it take you to get to where you are now? Have you taken other courses other than Brooks Price Action? Well, I think the underlying question here is how long does it take to become a profitable trader? But me personally, I've been doing this for somewhere around over 3 years. I don't know exactly, somewhere around 3 years. The first year I started out trading price action on the tick charts, tick and volume charts using Max method from priceactiontradingsystems.com. And at that time I was still working full-time as a manager for corporate America, so I was not trading real money. I was trading I would come home from work and trade I would replay the day like at a faster speed, and I would trade the entire day in about 2 hours. Then I traded some. That was when I was trading the E-mini. I traded. I took like a couple weeks of vacation or a couple days here and there, and I would trade. And during those times, I would trade real money, but I never. I thought that I knew what I was doing, and then I quit working full time to become a trader, and I started trading full time about 2 years ago. And during that time, I was still trading volume and tick charts, and I did that for probably 2 or 3 months, and then and I was trading real money at that time, and somewhere around after a few months of that, I realized that I was missing something, and I did not like the negative traders equation that Mac uses. I don't know if you're familiar with his method, but basically he uses a 2-point stop and a 1-point profit target, and that leads to a negative traders equation, which at that time I didn't necessarily. I somewhat understood the traders equation, but nowhere compared to what I do now. But so eventually I got fed up with that, and I knew of Al Brooks. I think I had read his first book by that point, but I was still trading volume and tick charts. So after getting fed up with the negative traders equation, and I got tired of losing money basically, and I felt like I was missing something, and so I bought Al's trilogy, his books, and from there I spent the next year focused on trading 5-minute charts. Still at that time I was trading the E-mini off and on sim mode, and eventually I realized that I needed to trade a smaller account balance and a smaller position size, so I switched to Forex, and that was probably I'd say right around a little over a year ago that I did that. But so I think that his underlying question is how long does it take to become a profitable trader, and I would say a minimum of 2 years. The first year it takes a year to learn price action and understand what prices are doing and why. and then it takes another year, I think, to develop yourself as a trader, both emotionally and figuring out what type of trader you are. You have to go through. What I did is after I read all of the books, I started trading Forex with 1,000 lots, and I tried every method. I started out as a scalper. I tried always in trading. I tried swing trading. I never was very good at swing trading or always in trading. So I primarily scalped until recently. I started trying to swing more. But like I said, I think his question is how long does it take to become a trader? And I'd say a minimum of 2 years. If anybody tells you anything differently, I'd say that they're probably a liar or a fool. And either way, you should turn and run. This is a very hard thing to do. It's not easy. You have to master yourself before you can master the markets. And that means mastering your emotions and being able at the same time understanding what prices are doing. And also, whenever I say it takes 2 years and a year to learn price action, that first year I did not. I ate, slept, and drank trading. Right, that was all I did. From sun up to sundown, that was all I did. Was I would trade. I would read in the afternoons. I would read 10 to 20 pages of each book, and then I would go back and review my day. I would review the charts bar by bar. I would do something similar to what I'm doing now with the marking of the best trades, and then I would go back and compare my trades and say, why did I not take this trade? Why did I take this trade? Basically things like that. But I also think that you can't just read Al's books one time and become a trader. I've read them, I don't even know how many times now. At least 2 times, probably 3 times, but I can't remember. I know I've read them at least twice, but I'm pretty sure I've read them 3 times. But like I said, you have to basically devote your life to trading during that first year and a half or 2. I think if you're trying to do this while working full time, I think it'll take you longer, probably 3 years. But like I said, that first year, you basically, this has to be something that you want to do, because if this is something that you're just trying to make easy money at, or you think that it's easy money, then I suggest you go do something like mow lawns, because easy money does not exist in the market and does not exist in this business. So I think that this is a very hard thing to do. I think this is the hardest thing to do. I have a saying, life is hard, trading is harder. I believe this is the hardest thing you will ever do in your life, and that's because it goes against your evolutionary flaws, or your DNA. It goes against your DNA to learn how to do this. And like I said, you have to master yourself before you can master your trading or the markets. And trading is an art form. Trading, there's no system that works for everybody. There's no system that works for all markets. There's no system that works for every part of the market cycle. So trading is very subjective. It's very hard to do, and like I said, it's an art form. So yeah, I think that it's very hard to do, and it takes a long time to be able to do this, especially making money full time on a regular basis. I think I have time for maybe like 1 or 2 more questions, and then I've got to go. I just want to say one more thing about that. So it's not only understanding what the market does and why, because that's crucial to understanding price action. It's easy to say there's a high to buy setup, but it's a lot more. I feel like you have to understand what the institutions do and why and how they manage trades. And I don't believe that. I took Al's first course, the video course, and I found that the books were way more informative, and the video courses did not necessarily provide you with the information you needed. However, I have not watched the newest course, and from what I've heard, the newest course is really good and possibly provides that information. I'm not sure, but the books, I think that the books really describe how describes why the price action works, how it works, and how the institutions manage trades. But understanding that is only the first part. It's one thing to know and understand why they do what they do and how to do it, but and this is the second year of what I was saying, that you have to then learn to apply your knowledge to the markets on a daily basis. So, like I said, for the first year, I was learning price action, and then the second year, which has been up until now, I have been applying my knowledge to the markets every day, and trying to develop myself into being a professional trader. So hopefully that answers your question. I hope that it's not, I in no way want to make anybody think that they can't do this, because I believe the opposite, that we can do anything we set our minds to. But you also have to understand that this is a very hard thing to do, and not everybody can do it. Not everybody has what it takes to do this. Okay, next question. Wedges are some kind of high 3 or low 3 entries, 3 attempts at reversing the trend. It can lead to a reversal or sideways. What do they need to be profitable? It might be a reasonable place to exit. A wedge there are different types of wedges. There's a wedge flag, and then there's a wedge reversal. This is a wedge reversal. A wedge reversal means that there are 3 pushes with the trend. So 1, 2, 3 pushes with the trend, and after a wedge, this would be considered a wedge bottom. Prices are likely to make a 2-legged correction. That 2-legged correction can lead back to the start of the wedge, like here, and form a trading range, or it can lead to a reversal, like here. And then a wedge flag is a continuation pattern where there's, say, a bull trend and then a 3-push pattern against the trend. And a wedge is a failed failure. So a wedge is in a bull trend, if there's a high 2 buy setup that fails, instead of reversing prices into a bear trend, the bulls attempt for a third time, and that is considered a wedge bull flag. And usually a wedge in a channel often have 3 pushes, and at the end of the 3 pushes, prices usually reverse for a minimum of 2 legs, sometimes reverse into a trend in the opposite direction, or form a trading range. It really is subjective and depends on many different factors as to what is more likely. But with experience, you learn to identify them in advance. So next question, is a strong signal bar enough to reverse the prior climax even when there has not been prior pressure against it? Yeah, well, once you understand why a climax works and what is happening in a climax, there doesn't have to be pressure against it. In fact, there's not going to be like a buy. You can consider this a buy climax. There's no selling pressure or no bear bars in this rally, right? But if you have to understand a climax and understand why that occurs, and that's because the bears have stepped aside. The bears are no longer willing to initiate shorts until prices reach a support and resistance level where they're comfortable selling again. So what happens? The bulls are able to drive the market up where the bears appear as if out of nowhere. So no, there does not have to be pressure against the climax, and most of the time there is not pressure. It's just like here is a good example. Strong bull breakout, right? But it's a buy climax. Second leg up, failed bull breakout, and instead of prices continuing, the bears they come in as if out of nowhere and sell and lead the market into a reversal. So, and a strong signal bar doesn't necessarily mean anything. A lot of times a climax and reversal comes from a weak signal bar. I don't know if there's any examples recently, but sometimes it's a doji bar, sometimes it's a bull bar. It just really depends. Most of the time, I would say there's some sign of a pause, usually it's like a doji or a reversal bar, but I've seen climaxes reverse from a bull bar like this. it's just a bull bar and then all of a sudden prices sell off. But usually it's from a doji or some type of reversal bar like here. I've only got time for one more question. So next question, how many bars do you think we have to focus on any chart to get context? Well, it kind of goes back to that earlier question, and it really depends. You have to analyze the price action both on a long term and a shorter term, but mainly the prior 20 to 40 bars, or I would say at least since the open. I may contradict myself whenever I say that, and it's probably confusing, but the context is very important, and a signal bar alone does not necessarily mean anything without context. My system is a context plus setup equals entry. Without context, there's no entry, and without a setup, there's no entry. So, like, just because prices are in a trading range and prices are at the top of the trading range does not mean that I'm going to sell. I'm going to wait for an entry at the top of a trading range to sell, like a low 2. So as far as how many bars to focus on, you need to be aware of support and resistance levels, but you also need to be aware of what the institutions are doing right now, because like I said earlier, prices can change from one part of the market cycle to another within a matter of a few bars. So I can't necessarily answer how many bars to focus on. I would say basically just focus on the day, focus on the open, and what prices have done since the open, and try to figure out what type of day it is early, and that way you can try to plan for the type of day and try to trade it the way that you should. So, all right, hopefully that answers the questions. That's all I've got time for today, so see you guys later.